So we are going to continue on making some more adjustments for a corporation, and the two adjustments that we're going to make this section are new ones for you. The first one's going to be merchandise inventory, and the second one is going to be interest receivable, and they're going to behave a little different than the ones that we've always known, where we debited an expense and credited an asset. So these are going to be different. So you might want to take a few notes on this one for sure. So let's start out with some definitions, hopefully that are somewhat obvious. So the first one is beginning inventory. That's the amount of inventory that I have on hand at the beginning of a fiscal period. So before I start doing any purchasing and selling for the year. So during the year I purchase and that inventory goes up, and I sell and that inventory goes down. And at the end of the year I need to record the actual amount of ending inventory as an asset on my financial statements. So how do I know how much? The way that I know is I have to do an actual count, which is called a physical inventory. So I go out into the retail store and I count how much I have in the front, in the back, anywhere it is, and I value that, and that's how much I need to have on my balance sheet. The key is that when I have a starting amount on my balance sheet and I purchase and sell, that amount at the end may go up, so I would have to debit the asset to adjust it, or it may go down, meaning I have to credit it. So that means I've sold more than I purchased, so the inventory had gone down. So this entry, it depends on what happened with that ending inventory. So this example that they're giving you here shows that the merchandise inventory started out at $108,486.44. That's what we have on our unadjusted trial balance. When I went and counted it, there was $102,838. So because when I counted it, it had gone down, I need to credit merchandise inventory, which I have done down here for that difference of $56.48. The debit is to income summary. So income summary acts like an inventory expense. So it is like an expense. So I'm debiting that expense and crediting merchandise inventory. And again, if this had gone from 108,000 up to 120,000 at the end, then I would need to debit merchandise inventory for $12,000, and I would need to credit income summary for $12,000. So it's these two accounts always, it's a matter of sometimes I debit merchandise inventory if it went up from the beginning to the end, and I credit merchandise inventory if it went down from the beginning to the end. So take a second and just make sure you kind of got that, or re-listen if you need to. So then we're going to do the other adjustment for this section. So it's important before we do this adjustment that we kind of review what you already know. So as you recall, generally accepted accounting principles, GAAP, are the rules we live by. And those rules require that any revenue be recorded in the accounting period in which it's earned. That's called the accounting concept of realization of revenue. So I have to record it in the period in which it's earned, even if I haven't gotten the cash yet. Okay, so that's what this adjustment is really related to, the one that we're doing. And there's lots of them we would do in a real corporation, but the one in this class we're going to do relates to interest receivable. So if you recall in section 14-3, we talked about promissory notes. And we had a note receivable where we calculated how much interest was earned on a note that's maybe a 90-day note, a 120-day note, something like that. And we took the interest and calculated it as principal times rate times time. And we did it for that entire note period. Well, the key is this. If I have a 90-day note that I agreed to and signed on December the 1st, it's not going to mature until February of next year. So at December 31st, I've earned interest from December 1st to December 31st. 30 days of that 90-day note, I've earned it. So I need to record that revenue in that period that I've earned it. So that's what this adjustment is related to. Interest that is earned but not yet received is called accrued interest revenue. It's accrued interest. So the accounts that I'm going to use when I do this adjustment is an interest receivable because I haven't gotten it yet, but I've earned it. So the receivable, just like all receivables, have a normal debit balance, increase as a debit, decrease as a credit, and then interest income for the amount I earned. It's income, it's a revenue account, so it's a normal credit, increases as a credit, decreases as a debit. So what is the entry that we would actually make? The entry that we would actually make is debiting the interest receivable for the amount that they will eventually pay us, but we've already earned, and record it in the interest income account. So $93 is the amount. So if it was me calculating this, I would still do the interest calculation as P times R times T, and I would take the principal times the rate, and the time would just be the 30 days out of 360 that I earned. Okay? So I've earned 30 days worth of it. So that calculation is still the same to get the amount. So ultimately, I had a balance already in interest income for other notes possibly, or savings accounts or whatever, and I make this adjustment, increasing the income and recording the receivable so that I get it down the road. And that is it on that adjustment. And let's just go through these real quick. It says, how's the amount of merchandise inventory on hand at the end of the fiscal year determined? Again, it's a physical inventory. I go out and I actually count it all and I value it. Then it says, how's the amount of merchandise inventory on hand at the end of the fiscal year? Sorry, that's the same one. What adjusting entry is recorded when the ending merchandise inventory is greater than the beginning? So beginning was low. It went up, so if it went up, I know that I'm going to have to debit inventory to make it go up, and it's always the other side of the entry is income summary. And then it says, how often is revenue earned on an outstanding note receivable? Every single day I earn revenue. And then what types of accounts are increased by recording an adjusting entry? And it increases my revenue for what I earned, and it increases my interest receivable account for the amount I should receive in the future. So that is it for this section.